2025 is here. So what are market participants thinking? Are there headwinds or are there tailwinds for 2025? If we look at the economy as a whole, we do have data sets that tell us the economy is good. Business is good. It's getting close to cycle highs, but is it there? The answer is no. When comparing the chart, there are only two options. Is this good or is this bad? The obvious answer is this is good. Unemployment. Do we have a high unemployment number? We do not. It is elevated from what looks like a bottom in the beginning of 2023, but it is just slightly elevated. This is an okay number. It is softening, so it does need to be watched, but once again, it is not bad. Inflation is lower. It topped out in June of 2022, but has been on a decline ever since. If the trend continues, the Fed's target goal, here in green, of 2% will be achieved in the next year as long as everything continues as is. If we take a quick look at the ratios that we keep an eye on, most of them are doing good overall, with the caveat that there is a near-term correction happening. Some of these are more important to watch than others, but if you click on most of them, you will see the same thing happening. There is a near-term trend correction happening, nothing major. But what about the Fed? Didn't the Fed pivot from their original dovish stance? Were they not predicting 4 cuts next year and then they cut that in half? And isn't that why the markets are selling off? I would say maybe. Some people believe the markets move because of the Fed, and others who believe the markets move the Fed. I would fit in with the latter, and this is why. If you look at the Fed fund rate in purple, which is the target interest rate, and you compare that with the 3-month bond yield in blue, or the 1-month bond yield in blue, you can clearly see the correlation. Let's now compare that with the 2-year yield. Once again, the correlation is high, but with some near-term volatility not being reflected in the Fed's target rate. That would lead me to believe the Fed does watch the 2-year bond, which is a tradable asset. I took a bullish position just the other day. This asset, because it is traded, will have near-term volatility. So the 2-year yield is correlated with the Fed fund target rate. The 2-year bond, the tradable asset, is not. It's inversely correlated. And we are currently seeing that volatility reflected in both the 2-year bond chart and the Fed's decision-making process. The reason I know this to be true is simple. We had a spike in the bond yield, pulling up the bond yield back up over here. This is the spike that I am referring to. It just simply means that it went up. And the Fed did slow at the rate at which they are cutting, as they want to see if this near-term spike will be corrected. If it does what the Fed thinks it will do, it will get back in line with their target rate, the purple line, and they can continue to cut slowly. Going back to the bond chart or the tradable chart, if the 2-year bond bulls, because these two assets are inversely correlated, as the bond yield or the 2-year yield spiked, the bonds pulled back. So if the bond bulls are right and they buy this region and it causes the bond to move higher, then the 2-year yield will correct and come back in line with the Fed fund target rate. If the 2-year bond bulls are wrong, the market will continue to sell off. The 2-year bond yield will continue to move higher, and then the Fed's decision-making process will become much more difficult. That, my friends, will and has been affecting the markets. If you are a bear, this is the scenario that you want. You want to see continued move lower in the bonds on the 2-year. But it also means that you are a contrarian. You are against the Fed. This has been a very failed position to have for the last 2 years, and the trend is usually your friend. To support the bearish thesis, you do have some metrics in favor with you. One of those metrics is the Shiller-Cape ratio. You can see that the Shiller-Cape ratio topped out at 38 38.5 and then moved in December of 2021 down to 38.3. Moving over to the S&P 500 chart, we can clearly see that December 2021 was the top of the S&P 500. The Shiller-Cape ratio as of right now is currently at 37.04 and has pulled back just slightly. The current Dow PE ratio is 38.5. That is 54% higher than the average. Over the last 6 years, the average PE ratio of the Dow has been 20.95%. So in closing, I could say there are a lot more data points going around on Twitter that lead to this being the top. Also, the world seems to be on the brink of war, according to some news organizations and some large dark pool prints on YouTube, which seems to be all the buzz these days, so I can see why so many people are bearish. But I have to think, even though a couple people have made careers by making fun of the Fed, I have to assume the Fed have hired smarter and far more capable individuals than of those and stick with the overall trend. It's up. This is probably a near-term correction that could take a month or two to straighten out, but the time to get super bearish is not yet upon us. So with that, thank you so much for your time. Thank you for being here. Make sure you guys trade safe, trade smart, and as always, happy trading, everybody.